Hello friends, we are here with one more stock analysis. I wanted to do this 2 weeks back, but it got delayed because of certain reasons. So one disclaimer, I hold the stock in my portfolio, but I have purchased at little lesser price, like 20% cheaper because the stock has run up in last few weeks. So take this stock purely from analysis perspective and you need to take a call on your own valuation. The stock which we are going to discuss is SJS Enterprises. It's in the automotive sector. And 2 weeks back, I made a video on automotive sector. I covered a lot of companies, the Q4 results, and I had covered this company also. But we'll look this company in detail. So the agenda is we will look in detail 10 reasons why this company looks very interesting. And in the process, we will try to understand the business model, the competition analysis, the financials, and also we'll look what kind of risks the company possesses so that we identify the holes in the story. So we'll look at the top 10 factors why this company looks interesting to me. And first we'll look at the 5 factors and then I will introduce 5 more factors. But before that, just little bit of understanding about the business and the product. So SJS Enterprises, it is one of the leading players in decorative aesthetics industry, catering to automotive and capital goods segment. Now the question is, what do you mean by decorative aesthetics? And I'm sure you would have seen a lot of bikes, a lot of cars in your home. You use washing machines, fridge, and you will see these kind of logos or decals. So all of this which you see here, like if you see on the bike, the logos and the decals which are there, or when you use your washing machine, you see a overlay which is basically an interaction medium to interact with the washing machine, or your automobile logos, or the kind of mod labeling you see on some of the healthcare products and all, or the chrome plating which you see in the car. So basically anything which is used to improve the aesthetics and the decoration and the look and feel of automotive or a consumer durable product, that is what is called decorative aesthetics, and the company is present in this segment, making many of these products. So this is what decorative aesthetics means. And the next question is design to delivery. So the company says it's a design to delivery solution provider with the ability to design, develop, and manufacture diverse product portfolios, which means the company designs. So how the logo should look like, what kind of color, what kind of material will be used. So right from the designing to how do you take it from design to shop floor, how do you manufacture it, how do you test it. So all the things right from conceptualization till delivery, the company takes care of. So the first why I find this company interesting. So first is takes many lines of checklist company. Now, what is a checklist company? And I'm sure many of you who would have attended these interviews or watched the interview of a lot of big investors, successful investors. Everybody says that we want a company which is debt free, which has a very good return on capital, return on equity, which can grow at a high rate with very good promoter. So there are so many criteria, and basically a company which ticks all of those criteria, I call it a checklist company. And whenever I look at a company, this is the first thing I will do. I will try to look at this any company on top 15 20 criterias of mine, and then I will see if satisfied all the criterias or not. So where does SJS stands in this checklist? And some of the key metric which I have on my checklist is the whether the company has debt or not, are the PAT margins decent, are the gross margins decent, are the cash flows good, is the growth in the top line, bottom line, is the industry growing at a decent rate, does the promoter have skin in the game, is the company good in terms of working capital management, is the company churning its asset properly to derive good return on asset, how are the return ratios in terms of return on capital, and then is the company valued at a decent level, and does the company has an honest and capable promoter, and are there business triggers. And I have my reasons to have certain kind of value. We do a lot of back end analysis in terms of history to understand what kind of values for these first, why these variables, what kind of value is suitable. There's a lot of research goes behind it, but keeping all of that aside, if we see this company except one or two things, few things it takes, and there are a few things we need to check. So it's almost a debt-free company with a very good 19% PAT margin, very good 60% gross margin, decent cash flow conversion ratio of 670 to 74%. Decent top line growth. Auto has been cyclic of late, but still the company has shown some kind of top line and bottom line growth. The industry is projected to have 20% plus growth. So I'm mentioning in check because there is a variation in number, and we need to see whether these numbers will come in future or not, or there are certain projections. We need to see if those projections will come or not. The only two thing where the company doesn't perfectly ticks the check mark is the working capital management, where the value is little beyond my comfort level. I'm more comfortable at less than 30%, but this company, it has around 33%. And second, valuation. And actually, when I analyzed almost 1-2 months back, or in fact even 2 weeks back, it was available at less than 20 PE, but of late, because of run up, the valuation has gone a bit higher. Now, the second thing is excellent financial economics. So when we talk of financial economics, I look through the whole detailed numbers of the company on 8-year, 3-year, 5-year, 1-year basis. Given this company is new, it's a newly listed company, but still, if we see the numbers look above the industry level, but the growth is subdued because of last 3 years auto cycle being very bad. The cash flow growth has been good. If you look at the cash flow growth of last 3 years, it is good. Majority of capex has happened without taking any debt. So if you see, the company has done almost 100 plus crore of capex, and still the company is debt free, which means the company is generating a lot of cash flows. And one thing is, the company is working capital intensive. There is the reasonable cash conversion. So if you see the CFO to PAT ratio, the company is able to convert its PAT into its cash flows. And even when you see the free cash flow to free cash flow conversion, despite of doing that capex, still the company is generating decent amount of free cash flows. And it's a high margin business, because when you look at the PAT margins, the company works almost on 16 to 19% kind of PAT margin numbers. So these are very good financial numbers. The third reason why this company is interesting, because the industry itself is expected to grow at a high rate, and take these numbers with pinch of salt. So because as per one of the CRISIL reports, the decorative aesthetics market is expected to grow at 20% plus. Now, the caveat is, this particular report of CRISIL, this report was specifically prepared for IPO of this company. And any report which is specifically prepared for IPO purposes and all, I take such reports with pinch of salt. The other thing is, if you look at this industry right now, there are 3 big players which cater almost 50% or 60% of the market. And out of 2000 crore market, these 3 players are somewhere around 1100, 1200 crore. And 2 of the players have not grown. This is the company which is growing. So if the historic growth has not been so great, I don't know why I should get confidence that this can grow at 20%. But yes, it looks like an industry which will grow, a subsector which will grow at higher rate than the overall industry. And if auto industry can grow at 7-8%, looks like this segment can grow at 10% plus. The FM consumer goods industry, basically the white goods, I think that industry is growing at 9-10%. So this can grow at 12-13% plus. And if the company can outperform its subsegment, then maybe it can grow at 15% plus. So I'm just trying to set a realistic expectation rather than purely taking a CRISIL report. And then as per report, you have the numbers of how the two-wheeler aesthetic industry, passenger and consumer durable will grow. So these are the breakups just to track. And then in terms of products, there are certain products which are old, like decals and stickers, commoditized product, a lot of competition. So expect lower growth rate versus new products like, overlays and chrome plating, or IMLs, which are expected to grow at little higher rate. The next thing is the auto cycle, 4th point. Auto sector itself is at its cyclic low. So why I'm highlighting, and again, I have highlighted this in the previous video. If you've not seen that video, the link is there. The link is there in description. You see it. So there is no industry which is not cyclic. And usually from a value investing perspective, buying something which is going through its pain period, it helps to buy things cheaper, because nobody is optimistic, and the valuations you get that time, they're relatively fairer. Again, no question, not telling about this company because the company has run up despite of index or the sector, the Nifty not doing well. But the whole auto sector is at cyclic low. The last 3-4 years of growth have been negative. You watch my previous auto sector video for more details, but looks like when the sector cycle will turn, we can have a good time, and 7-8% of sector growth rate can come. And this is the data. So on the average, the sector at peak long-term CAGR has been 8%. But if you take two-wheeler, four-wheeler, the CAGR is at 2.8% for last 5, 7, 10-year kind of CAGR, which is, even the GDP is growing at 4, 5, 6, 7%. So this rate is very low, and sooner or later, once the rural issues get resolved, once the the supply chain issues in terms of chip shortage gets resolved, it will turn. And actually it is happening. If you see the passenger vehicle, it is relatively doing better. Commercial vehicle is really doing good. Two-wheeler is still suffering, and the low-cost rural two-wheeler SKUs, they are suffering a lot. So from cyclicity perspective also, there is no froth as of now. And fifth, the company has been the best performing company among peers. And when I first studied the company, the kind of margins it had, 16% PAT margin, shocked me that is it possible? And actually, when I analyzed, I saw it's not the only company. So out of 6-7 companies in India, the three biggest companies are Polyplastic, Classic Stripes, and SJS. In terms of top line, Polyplastic is the biggest company, doing almost 450-500 crore of revenue. Classic Stripe and SJS around number 2. I think SJS is now number 2 with 375 crore. The other two companies are private companies, but I have tried to pull as much as data possible. So first, Polyplastic, I don't see Polyplastic doing really well because they're number 1 in top line. But if you see the growth has been very bad. The financial ratios have been deteriorating. The debt equity is increasing, and I will tell you the reason why it is happening. The simple reason is, if you look at the competitive intensity across products, and these are all the companies, and these are the traditional products, and these are the advanced products, and these are the business segment. If you see Polyplastic, they're present only in the traditional aesthetic products, which are commoditized low margin products. They have not been able to get into advanced products, which are higher margin products. So maybe that is the reason why their revenue is constant, their margins are deteriorating, and all of that. So the real competition is coming from Classic Stripe. It also has decent margin, decent EBITDA, but this is also not growing. So Hero is one of the big customer, but when you see the 7-year revenue growth, nothing exciting. But in terms of balance sheet, in terms of cash flow, it is a very good company with very good return ROCEs. So the numbers are very much comparable to SJS, and that gave me some kind of comfort that these are not outlier numbers. There are other companies also in the industry which do. And the reason why Classic Stripe has been able to maintain these kind of margins, these kind of return on capital, because when we see the product profile of Classic Stripe, it is not only present in the commodity product, but they have been able to tap into advanced technology products. So out of these 4, they are present in 3D dials and capacitive overlays. Also, they are present in multiple industries, which gives a diverse revenue portfolio. But when you look at SJS is present across all the products, whether it's commodity or advanced, and also they're present across all the business segment. So in terms of product portfolio, in terms of advancement to new product, in terms of penetration to new industries, in terms of growth, in terms of balance sheet, in terms of return ratios, everywhere looks to me that SJS outperforms easily Polyplastic and also Classic Strips in terms of growth. So now let's look at the next 5 factors, factor number 6 to 10. So there is a strong order book driven growth guidance. Again, take these things with pinch of salt because there's a new IPO, hardly 1.5 years old. The management is not proven in terms of public. So we need to see if they live up to the promises and they deliver what they are telling in the con call. But in the con call, they have given a guidance of 25% revenue growth for the coming year. And they are saying 80 to 85% of this projected number is already secured through the order book. So that is what makes it interesting. So, if they can grow at 25% top line, and COVID was one of the worst time for auto industry. Many companies suffered on margin. We know the kind of results which are coming. and still the company was able to maintain its margins. So that gives some confidence that if the growth will come, if the margin doesn't improve, at least looks to me it won't deteriorate. But let's see if they execute on this. But that looks another interesting point. Seventh, so to manage this growth, are they going to do a lot of capex? And the answer is no, because major of the capacities are still to be utilized. And the company has two capacities, one in Pune and one in Bangalore. In the financials, you saw the company spent 108 crore on the capex, which was spent on the Bangalore plant, which is almost 7-8 times more than the Pune plant with 208.6 million part capacity. And these capacities interchangeable if you want to do it across different products and SKUs. And if we look at the capacity utilization, both of these capacities are around 50% utilization. So there is tremendous aspect, and right now the company has done almost 370 crore of turnover. So my sense is still 600-650 crore of turnover. They don't need to create new capacities until they see more demand coming, which they have highlighted, and actually they will be doing some capacity for some more new demand coming. But there is some scope of operating leverage surely, because the current capacities are underutilized at 50-60% level, whether we see by location, we see by industry, we should see by product portfolio. Point number 8, export opportunities. And the company has started taking sports seriously in last 4-5 years. After the new CEO came and the new PE fund came in 2015, and the export revenue, which used to be 10%, less than 10% in FY19, this has jumped to 16%. There has been an acquisition. That acquisition was domestic acquisition, so the revenue numbers are adding to domestic. But despite of that, even in current year, they have been able to maintain same kind of export share. And my sense is still I am trying to research, find more, but looks to me that export might have a decent margin. Because if we look at the business, 10 to 20% of the employee based and the expenses, they are on the design side. And my guess is when we look at the design per hour billing rate in developed nations versus India, I'm sure there would be some kind of billing rate advantages, and if they can deliver the same kind of design quality and all, there would be some opportunities to tap on the export, both from growth as well as from the margin perspective. So export opportunities are there. 9, multi-industry, multi-product, multi-SKU. And I have been trying to research and dig a lot what is special about this company, because how can a company make 16%, 17% kind of PAT margins? Is there a barrier to entry? And I see a lot of similar kind of questions. The things which I concluded it, no, it doesn't look to me it's a high barrier to entry kind of business. But what looks to me is, first, it's a 2000 crore market. It's not a very big market that every big company would like to get into it. And in a small market, there are some niche around design and serving new products, serving multiple products, serving multiple SKUs. So I think the overall capability to work in multiple industries with multiple products, with multiple SKUs, with a full-fledged design team, and then ability to do things better than the other players, I think that is what stands out. So design is a very, very important thing, and they have a dedicated design team, which is almost 10% of the workforce. And in terms of salary, it would be a bit higher, and that helps them to create the good aesthetics, because it is all about aesthetics. And then they provide the whole end-to-end solution, right from design to manufacturing and testing. Also, we saw in terms of product portfolio, they are much ahead compared to other peers. They are present in all of the products, and they're present in all the advanced products. They're present in multiple business segments. So combining, and they have more than 10 plus 15 years relationship with the large players. So all these capability with the ability to provide wide range of SKUs. In fact, they have 6,000 plus SKUs. So that kind of capability to do in a market which is not of very big size, a fragmented market, I think that is what makes them unique. And so far they have been able to deliver these kind of margins even in COVID times. I don't think for somebody entering and killing these margins is difficult, but given the market opportunity size is 2000 crore, it will become 4000, 5000 crore. I think we need to see if more players are getting interested in entering and they're able to dent. But This is what I could conclude is working in their favor for, the kind of numbers they are having. And the last but the most important thing is management background. So the management team is interesting. So the company name SJS comprises of the first letter from 3 promoters, and actually 2 promoters, they exited the business in 2015. And Mr. Joseph, he stayed. And when the other 2 promoters, they exited, a P fund took stake, which was Everstone Capital. So right now, I think even post IPO, I think 43% or some 35 or 43% is there with the Everstone Capital. 15% is there with Mr. Joseph. Earlier, he was holding 20%, and the IPO, he offloaded 5%, but still he's holding 15%. So he's more of a technocrat. And I would suggest you go through the latest con call, the latest investor presentation. There are going to be certain leadership changes. His role, he'll be focusing more on the R&D and the technocrat side. When this P fund came, they got Mr. Sanjay Thapar on board in 2015 as ED and CEO, and he comes from Minda Group. So again, Minda is a very, very interesting company, very good company in automotive sector, and somebody is coming from Minda. I think there is some kind of legacy skill, some kind of skill set he's carrying, and he has delivered in terms of growing the business, in terms of growing the export business. And even his role is going to change a little bit. If you see the recent con call, he will be focusing more on certain aspects of business related to acquisitions, M&A and all. And the star means they have equity, so he is anyway co-founder, but he is also having some equity, some skin in the game. There are 2 people on the board who are representing the PE fund, and some of the top CXOs, they are also holding equity, which says that they have skin in the game, whether it's the chief marketing officer or chief operating officer. There is a flavor of design even in the board. Like if you see Mr. Kevin Joseph, he comes from Tata Elxsi, and Tata Elxsi has a design business. So I see the board and the key management people very well balanced, some skin in the game, and they are going to hire one more person who will be driving the domestic business, but that hiring has not been done. So let's see how all of this evolves. But this is the kind of management which has performed. Now let's look at holes in the story. Why there are risks? Nothing in equity comes without risk. So first risk now itself, business cyclicity, because even this company last 3 years of growth rate has not been good, because auto is a cyclic industry. So whenever we invest or don't invest, we need to track the auto cycle, and the performance of this company is not going to be uniform. It will depend on the auto cycle. Second, test of time. I like companies who have gone through the test of time, because I can trust them looking at their history of 5-10 years. But this company is new, and new companies, you never know how the management is going to behave, how they are going to treat minority shareholders. So at least in my portfolio, I have rules built around, if a company is new, I will not, however attractive it is, I will not allocate more than X% and all of that. So we need to test the management and the company over a longer period of time. Competitors, in way, when the certain businesses, they have very good financial economics, competitors, they just come like honeybees. Like, see what is happening in diagnostic sector. So if industries don't have a strong barrier to entry and the financial economics is very good, it's a very, very risky situation, because it can change in 2 years. And the companies which are growing at very high rate with very high ROCE, somebody who is not managing that kind of margin in his own business, he will think like, oh my God, there is a big opportunity. I am making 10% ROCE, this business I can do 13%. Why not? I should get into this business. There is no barrier to entry. So the companies which are doing 30% ROCE, they will suffer, and they will also come down until they have barrier to entry. So we need to track this kind of competitors in way which can happen in this particular sector. And given it's a PE fund owned company, usually PE funds, they exit, and this company, PE fund has already done an OFS. What if they exit or they reduce stake? Who will be next promoter? Because the main promoter only holds 15%. So how that will pan out, that is something we need to track. Also, we do a lot of this kind of analysis as a part of our membership program. We track a lot of companies, a lot of industries. Like we are not talking about valuation here, but in our membership program, we talk about valuation. We build the full-blown, Excel models. We try to track the valuation. We are present both through a website, and recently we have launched our Android app. I will make a small video about our Android app. Already 50 hours of content is present there every month. We add 5-6 hours of content. We provide regular updates on the companies we are tracking, the market, how to track markets, a lot of things. We don't not only rely on fundamental, but we also try to rely on technicals and quants to take calls on companies and sectors and all of that. So do check our website, learn.scientificinvesting.in, in case you are interested to pursue. But coming back to the company, key items to monitor. So how we should track this company, and there are a few things which we need to track. So how the company is going to treat its minority shareholder, I think that will do a make or break for this company. What kind of long-term performance it delivers for shareholders. Second, the kind of projections company has given in terms of growth, which is order book based, the export focused, how the non-automotive, because consumer durables relatively lesser cyclic, and how the company gets into premium products. Because you see, if the company would have stayed in the old gen products, they would have gone through cannibalization of gone through margin compression, like which happened with one of the company. And also they generate a lot of cash, and recently the company is going through a structural management structure change, and looks like there is going to be a lot of focus on the inorganic growth M&A side. So we need to track these stories. We need to track the promoter stake sale because the PE fund is there. Margin sustainability, because still, despite of doing all this research, finding reasons, still I find these margins are too good and some or other company will get interested. So we need to really track the margins. We need to track the auto cycle revival, because still the cycle revival has not happened. Two-wheeler is still suffering. 2 days back, we got the FADA numbers for May. Two-wheeler, the low-cost two-wheeler still, it's in bad shape. And all this leadership change, which new person is coming, is it coming without making any value addition, because already they have a co-promoter and they have a executive director. So what kind of value each of these people they will bring to the table? So that was all about SJS Enterprises. I suggest you do your own analysis, you do your valuation analysis and comfort, and then take a call. And if you liked our video, do like it. If you have any open questions, do put your questions. If there is any other company in auto sector you want us to analyze, mention in the comment box and we'll do it. And like and subscribe our channel so that we can reach out to more and more people and make more such videos. Thank you.